Welcome to our comprehensive study of international trade. Why do countries trade? At its core, trade is about optimizing resources. We begin with the Production Possibilities Frontier, or PPF. This graph represents the maximum output an economy can produce given its fixed resources. If a point is on the line, the economy is efficient. If it's below, it's underperforming. Crucially, the slope of the PPF tells us the opportunity cost, the price of choosing to produce one good over another. In this session, we'll move from these basic curves to the complex global systems of exchange rates and international development. A common mistake is thinking countries only trade when they are better at making something. That's absolute advantage. However, trade is actually driven by comparative advantage, the ability to produce a good at a lower opportunity cost. Imagine orange land and cloth land. Even if orange land is better at producing both oranges and cloth, they should focus on whichever they produce most efficiently relative to the other. By specializing in their comparative advantage, both nations can consume more than they could alone. This is the logic behind international specialization. Once countries specialize, they must agree on the terms of trade, the ratio for swapping exports for imports. For trade to be beneficial, this ratio must fall between the slopes of both countries' PPFs. We measure the success of these trades through utility, or consumer satisfaction. In economic modeling, we use an indifference curve to represent combinations of goods that provide equal satisfaction. The ultimate goal is to find the intersection where the highest possible indifference curve meets the PPF, maximizing the gains from trade for the entire nation. Not all trade is free. Governments often use tariffs, taxes on imports, to protect local industries. Let's look at the market for cloth in orange land. Before a tariff, consumers enjoy a large consumer surplus, which is the difference between what they are willing to pay and the lower market price. However, local producers might struggle. When a tariff is applied, the price rises. This increases producer surplus for local businesses, but shrinks the consumer surplus. In economics, we calculate these as triangles on a supply and demand graph to see the net effect on national welfare. While tariffs are taxes, quotas are hard limits on the quantity of imports. Think of the 2002 U.S. steel tariffs and subsequent quota discussions. The goal was to give domestic steel mills a breathing room from foreign competition. The result? While it helped save some steel-working jobs, it drastically increased costs for American car manufacturers and construction firms who needed that steel. This illustrates the trade-off. Protectionism helps specific producers, but often at a higher cost to the broader economy and the average consumer. To prevent trade wars, we have the World Trade Organization, or WTO. This multilateral organization promotes free trade by setting rules and resolving disputes. The WTO encourages the formation of common markets, groups of countries that agree to minimize or eliminate trade restrictions among themselves. By reducing tariffs and quotas collectively, these nations aim for higher efficiency and stronger economic ties, moving toward a truly globalized goods market. How much does a country PA participate in the global economy? We measure this through openness. The formula is the sum of exports and imports divided by the country's total GDP, multiplied by 100 to get a percentage. A high percentage indicates a country is very integrated with the world market. For instance, smaller nations like Singapore often have openness scores over 100%, meaning their total trade actually exceeds their domestic production. This metric helps us distinguish between inward-looking economies and global trading hubs. The trade balance, or net exports, is simply the value of exports minus imports. If the result is positive, the country has a trade surplus. It's selling more than it buys. If it's negative, like in the United States for several decades, it has a trade deficit. While deficit sounds negative, it often just reflects a high domestic demand for foreign goods and is balanced out by other financial flows we'll look at next. To track every transaction, economists use the balance of payments. This is divided into two main accounts. The current account covers the trade balance, goods and services. The capital account tracks the financial market and net capital flow, or net CF. Net CF is the net flow of funds a country invests abroad. A positive NCF means the country is a net lender to the rest of the world. In a perfectly balanced system, a trade deficit in the current account is offset by a surplus in the capital account as foreign investment flows back in. Trade isn't just about goods, it's about the people who make them. Labor productivity, the quantity of goods one worker can produce, determines a nation's competitive edge. However, international markets also lead to brain drain. This occurs when highly skilled workers emigrate from developing nations to wealthier ones in search of better wages or working conditions. While this benefits the receiving country, it can hinder the economic development of the home country by depleting its most valuable human capital. When we trade across borders, we must swap currencies using the nominal exchange rate. But does $1 buy the same amount of stuff everywhere? This is the theory of purchasing power parity, or PPP. PPP suggests that in the long run, exchange rates should adjust so that a basket of goods costs the same in all countries. However, things like trade restrictions, differing quality, and non-tradable services, like haircuts, often prevent PPP from holding true in the short term. To truly compare the price of goods between countries, we use the real exchange rate. The formula takes the nominal exchange rate, multiplies it by the foreign price level, and divides it by the domestic price level. This tells us how many domestic goods are needed to buy a foreign good. If the real exchange rate is high, domestic goods are relatively expensive, which might hurt exports. If it's low, the country's goods are on sale to the rest of the world, potentially boosting the trade balance. Countries choose different ways to manage their currency. In a floating system, supply and demand determine the value. If more people want the currency, its value rises. In a fixed system, the rate stays constant. Some nations choose pegging, where they commit to a fixed rate against a major currency like the US dollar. This provides stability for trade but requires the central bank to have large foreign currency reserves, often managed with help from the International Monetary Fund, or IMF. A famous example of a fixed system was the Bretton Woods Agreement. Established after World War II, it set the US dollar at a constant price per ounce of gold, and other member nations fixed their currencies to the dollar. This created a period of massive stability that helped rebuild the global economy. However, as global markets grew, the system became too rigid. By the early 1970s, the world largely moved toward the floating exchange rates we see today, though many developing nations still use pegs to attract investment. Ultimately, trade is a tool for economic development, improving the quality of life. We measure this through per capita GDP, which is the total GDP divided by the total population. By engaging in international trade, increasing labor productivity, and adopting new technologies, a country can produce more wealth per person. This isn't just about numbers, it's about the ability of a nation to provide better health, education, and infrastructure for its citizens. We've traveled from the simple curves of the PPF to the complex world of the IMF and global exchange rates. International trade is more than just swapping goods. It is a sophisticated dance of comparative advantage, labor migration, and financial flows. As you continue your studies, remember that every policy, whether a tariff or an exchange rate peg, has ripple effects across the entire global economy. Thank you for joining this deep dive into international trade. Study these formulas, and we'll see you in the next session.